joining us now for a closer look at what's currently playing itself out on the market scene is Gwebes Potgieter from Southern Cross Capital. Gwebes, thanks so much for joining us today. Now let's start off with assessing what's actually happening in markets. Sentiment has been somewhat downbeat, most stocks closing in the red yesterday. We have seen somewhat of a mixed start today. Is there anything in particular driving markets, or are investors just being cautious ahead of the Fed minutes, ahead of Nvidia's results, etc., etc.?
Markets, I mean, been under substantial pressure all year so far. So you're absolutely right. Stripping out Nvidia and a couple of other big tech stocks, you'll find that all asset classes across most exchanges are down significantly year to date, and those handful of names have actually supported the overall equity outlook almost artificially. So yes, a little bit of wait and see. In terms of action, I suppose we saw stimulus and support coming through for equity markets in the form of banking regulation relaxation within China, further support for those distressed property businesses, and we're seeing a little bit more conviction around the Chinese government's intervening in supporting that economy and hopefully getting things chugging along again. Other than that, as you mentioned, we're waiting for the Fed minutes. That's still bated breath. They've really put a dampener on markets by postponing the possibility of cuts within Q1. And ultimately, we're looking for more certainty around whether or not we're going to see cuts by Q2. And of course, locally, bated breath, waiting for the budget speech. Despite the inflation print, I know it's still, it's towards the middle of the range, and it is a slight increase, at least on a core level. But ultimately, it was better than expectation. And a reasonably benign print, and more or less a positive reaction from both the ZAR and bonds in the immediate wake of that inflation print.
Listen, I'm crossing fingers and toes that the Fed starts cutting rates soon, so we can also start seeing rate cuts on the local front. Now, I want us to zoom in on the nervousness that has played itself out ahead of Nvidia's results, Gwebes. What's that about? Surely we're going to see upbeat earnings from Nvidia on the back of that AI boom.
This is a tulip mania all over again. So just to give you an idea, we've got some wizards in the derivative space that have calculated the likely market movement within Nvidia, regardless of what the results are. So ultimately, it's binary. There is so much bullishness in the price that no matter what they do, they will either disappoint or beat. And the minimum move priced in is around $200 billion in market cap. So it's the most followed stock. It's almost like a New Year's countdown at this stage. People have got massive clocks to watch this on every website. It's absolute madness. And unlike previous bubbles or crazes, the likes of cryptos and similar asset bubbles, this isn't just retail. It's got a massive retail following, but it's got a massive institutional following as well, and people are sort of betting the farm. Our own expectation is probably for a stellar set of results. Their margins are through the roof. They are moving cards. It's at an absolute rate of knots, and making real amazing margins and real profit. It's not fake. It's not fictional. However, we do expect a slowdown, given that supply constraint situation does seem to be tapping off. A lot of the acquirers of these cards for AI purposes are filling up, and we've seen the market reactions from their competitors also trying to cash in on these super profits. So perhaps we'll see a slowing in that trend from an Nvidia perspective in this set of results, if not certainly by the next set, where we definitely expect their competitors to start eating into that share. And as we've mentioned, the supply constraint situation from a TMNC, of course, their semiconductor manufacturer, they've largely alleviated those issues. So people can buy as much as they like, more or less. And for that reason, those super profits might taper off in the near future.
Now let's bring it back home. We've had quite a few earnings come out as well as trading updates. Let's start off with Bidcorp. So recording growth across all its markets. Are those numbers sustainable? I mean, we've been seeing growth from Bidcorp post-COVID-19. Looking at today's numbers in relation to the previous period, where they had about 30% increase in HEPS, now we're seeing 18%. Are we going to do you think we're going to continue to see a slowdown in earnings growth from that front?
Yes, and this slump, I mean slump, but still they still have growth, which is better than a lot of local reporting companies. To be clear, it's actually more severe than the headline number shows. In constant currency terms, we're not talking 19%, 18%. We're talking around 6.8%. So that's already tapering off a little bit, and it'll be interesting to see the conversation you have with the CEO later on. But they have specifically alluded to food inflation actually putting pressure on the underlying customers. And this is not just locally, this is a global phenomena in all of the markets they operate. So there is certainly some pressure from that perspective. And the growth, once adjusted for constant currency, isn't nearly as exciting as we've become accustomed to. Having said that, the market's a little bit disappointed in these numbers today, but they're very well positioned, and to some extent you're taking a view again on that inflation outlook improving somewhat, and that all trajectory being able to be resumed. So it's a good set of results, absolutely, but it's not nearly in terms of growth as exciting as what we've become accustomed to with Bidcorp.
Something that's also not exciting are the numbers out of the mining sector. Glenis Glencore out with numbers today, earnings they halving on the back of lower commodity prices. I mean, this was expected, right?
Yes, I think relative to some of their peers in the more precious metal space, this is not as shocking as you would imagine. But what is surprising is this is still one of their record performances. They've just come off such a high base, and the war in Ukraine was a perfect storm for their business, specifically their exposure to energy assets, coal and petroleum. Their trading business, which tends to flourish in situations where markets become disjointed. So obviously we had all of this weird disruption around Russian oil not being moved to Western markets anymore, and these disruptions cause opportunities for the trading business. And their trading business profit went from around $6.5 billion USD to half of that in the last period, despite persistent issues. And of course, the overall cost of those energy assets, the coal in particular, coming off significantly. And thirdly, they have a lot of exposure to the so-called new generation of metals in EVs. And we all know that sort of the excitement around EVs has tapered off. There seems to be more of a move towards hybrid, and the rates of production of EVs or sales of EVs have slowed down significantly. And perhaps that rollout was a tad aggressive on top of this tech acquisition, which of course took them from a net, they had no debt. There was no debt on the balance sheet, took them to significant debt, and now they're having to pay down that debt and ultimately stop doing share buybacks and capital returns as attractive as previously. So it's somewhat cyclical. It's still very well run, and this is still a record performance, to be clear, just not the record performance of last year, around half of that performance. They're still well positioned. It's should those markets recover. And the exciting thing, I think, is from this tech acquisition, they're taking those coal assets, combining it with their existing coal assets, and their intention is to spin that off. So that might end up being a significant value unlock for shareholders, in addition to the deleveraging opportunity they've gotten from leveraging up this balance sheet and now paying down that debt and getting back to a more profitable trajectory.
Now, it'll be interesting to see how that whole deal plays out. But before I let you go, Glenis, what is your stock pick today?
So I guess I've touched on it already. So it's the Satrix China ETF. It's a little bit boring to pick in an exchange traded fund, but I'm tired of picking Naspers or Prosus whenever we call China cheap, and Tencent isn't as cheap as the broader Chinese exchange. And I know South African managers get a lot of their Chinese exposure via those two big stocks, but ultimately we also have the possibility of using a passive to get exposure to the broader exchange. It's recovered a little bit in rand terms, at least from its bottom around a week ago. I believe the 14th of Feb really bottomed out, but it's still incredibly cheap. And if we see continued conviction, and of course the sort of global outlook is that Chinese, this Chinese slowdown is bottoming out in 2024. Given that these Chinese equities are so cheap at the moment, it looks like a good opportunity to add that to your portfolio and participate in that upside as they are expected to recover over the following 12 months.
Cobus, thanks so much for your time and those insights. That was Cobus Potgieter from Southern Cross Capital.